All right, traders, Kill Stokes here. Welcome back to part 3 of building a Forex strategy. If you guys are brand new, make sure you go back and watch part 1 and part 2. That way you kind of have an idea of what we've been doing and how we got into this point. But this is basically a diary that I've been doing all winter break, December into January, of the process, or showing you guys the process that I go through when creating a Forex strategy or trading strategy in general, but this one specifically for the Forex market. And the goal of this isn't to kind of give you the answer. I know a lot of you guys, probably not watching this channel, but a lot of you guys that watch YouTube, you do so, you just want the answer. The goal is to kind of show you the process, the different steps that are taken, because I think in general, a lot of traders think that trading is easy, creating a strategy is easy. And I don't want to make it seem like it's really, really difficult, but it does require a lot of work. It does require a lot of time, and it does require some very specific steps if you want to ensure that what you're doing works correctly and instead of just, having something that is random. So to give you guys a brief little recap, in phase 1 or part 1, we talked about establishing a baseline test. That was simply just proving that my hypothesis in the market worked. If this happened, then I would expect this to happen, or if this happened, then this should happen, and doing some baseline tests, no filters, no qualifiers, just very bare bones to see if the general idea worked. After that was successful, I moved on to part 2, which was finding better entries. So trying to eliminate some of the losses from the baseline test by adding confirmation at entry. If you guys remember that video, it didn't really go too well at first, but I did end up having something that may work. And now part 3, we're going to talk a little bit about target taking and trying to optimize the strategy, again, up to this point, by experimenting with different ways of taking targets. And I think it's important to remind you guys of this. This is just the preliminary phases of strategy development. This isn't even really the back testing part of it. This is simply kind of seeing if the idea works. It's the work before the work. Hopefully, if the idea does prove to work, then I can actually take it to the normal back testing process and go about creating my portfolio and making any other tweaks. But at this point, I'm just trying to develop a clear, concise set of rules for what I want to do. So I don't mean that to be kind of discouraging, but it takes a lot of work, and again, you guys need to understand that it is worth it at the end. Don't get me wrong; all the work is worth it. You can ask any consistently profitable trader, but it does take a lot of work, and that work can take a lot of time. So what I'm looking for with targets is slightly different than what I usually do. For you guys that are familiar with how I trade, my targets and really everything I do trading wise is based off of structure, right? Structure is the centerpiece of my trading philosophy, support, resistance, supply, demand, whatever you want to call it. Typically, my targets are taken, as far as my other trading styles go, they are taken using a technique called think like the other trader, meaning I want to get out before traders on the other side of the party get involved, basically before the move wants to reverse. For this strategy, which is a higher time frame, remember this is on the daily chart, so this is a higher time frame trend following strategy. I'm opting to do a slightly different approach. Again, I have no idea. I may go back and implement structure in it, but at this point, I'm looking to do a slightly different approach, and I'm using the ATR. Now, the ATR stands for average true range. It is basically a measure of volatility. It's the average range of X amount of candles, whatever period you have your ATR set to. But it tells you basically the average movement in the market. And for you guys that are familiar with me, this is something that I use for my stop losses, right? All of my stop losses are based off of some type of multiplier of the ATR, and the market is likely to move within this range. So having it this high above should give me a good sign. It should give me a good sign that the trade has failed. If it's wrong, yet enough kind of a buffer not to get caught up in kind of the tricky places that newer traders put stops and get skunked out and turn around and see the market go in their original direction without them being involved. But I also want to use it, or I want to use it in this case for target taking. And this is something that I did before. I used to trade a trading strategy very similar to this very long time ago at the beginning stages of my trading career. Maybe not similar as far as the execution, but a higher time frame trend continuation strategy. And ATRs targets were based off ATRs back then, and it worked pretty good. So that's something that I've always kept kind of in my brain, kind of in the storage container of trading knowledge, and I want to bring it back out for this. And what I'm going to do here is I'm going to test multiple multipliers of that ATR, and I'll show you guys a chart in a little bit giving a comparison. But something I did during the initial baseline tests, I don't think I showed you guys this, but I measured something, or I kept track of something called MFE. That's the Maximum Favorable Excursion. MFE, Maximum Favorable Excursion. It's one of the fancier words that I know to make myself sound smart. But essentially what it is you're asking yourself, what is the peak profit level, right? What is the maximum amount of profit that could have been taken on the trade? So essentially, if you're looking to get short, right, how long, what was the maximum point that the market got short to before it reversed and eventually would have stopped you out? So what is if everything was perfect, what is the absolute most you could have gotten on the trade? And I measured that for every single trade, all 235 of them. And I did so because I had planned on using some type of ATR multiplier, at least testing it. And by testing, keeping track of the ATR in every single trade, keeping track of the maximum favorable excursion, it would give me a very good idea on average what type of movement we were looking for. Now, what's important to realize when you do this, and the bigger the sample size, the better, is that there are going to be outliers. There were a few trades, a handful of trades that were, 2,000 or 2,000 plus pips, right? That's what the maximum favorable excursion was. Obviously, that is not the norm, but so those numbers are going to kind of throw things off. So you want to make sure to keep that into account. Obviously, the bigger the sample size you have, the less impact that's going to have on your result. But let's say you're someone that isn't doing your testing correctly. Let's say you test all of 10 trades, right? And one of the MFEs on those trades was 2,000, right? That's going to significantly throw off your average. So you want to take that into account. And the practice that I used to do back in the day was I would always remove my biggest winner and my biggest loser, just to kind of get, if there are any outliers, just to really get an idea of what the reality looks like. Because again, a lot of times traders are testing strategies, and the strategy is performing kind of break even, but they got this 2,000 pip winner, and now when they look at the results at the end, it's like, oh man, a 2,000 pip year. But in reality, it was only one trade. It was an outlier trade. How often is that big move going to be caught on an annual basis? And the likelihood is probably not too often. So you're really giving yourself a false impression of what to expect. But again, I did have a really big sample size, so it did help even it out. But so while I was tracking this, I had a good idea on what I thought my maximum favorable excursion would be. It was a little bit over 2. And but because I'm curious, when I went back and decided to test different ATR multipliers, I tested all of them anyway, from 1 to 1.5 to 1.75 to 2 to 2.5 to 3, just because, again, if I'm going to do something, I might as well just do it all the way through the first time instead of have any questions about it. So I did it for both the baseline test, that's the chart in front of you that says naked, right? And then I did it for the Q4 qualifier, right? That was the fourth qualifier that we talked about in the last video, and wanted to compare the results. And this is a topic, these numbers don't mean a lot for me right now. I should put that first and foremost, mainly because I still haven't added the part about, well, let's put this. I haven't changed what I'm doing with stops. If you guys remember in the last video, we talked about, as I was looking for different qualifiers for entry, I came across something that I think might be a better way of exiting trade. So a better trailing stop, I guess you can say. which is different from the original trailing stop that I tested, which is ironic because that's what I was that was the one thing I was very, very confident about, and now I may not be using it. We'll see. So when I do end up testing and seeing if that different trailing stop works, it is going to throw off some of these numbers. So these numbers are for a grain of salt. Again, the idea is not to get the specific data that I would get during back testing, rather just an idea, a way to filter out what I want to test once the back testing really begins. But I was talking to a trader on the Tier 1 platform the other day. He was doing back testing of his own, and we were kind of talking about just how you should test different things just to see kind of how to maximize your profit. And I had a really good analogy where I said, when I do testing, especially I look at it as far as the maximum favorable excursion goes, I look at it like stretching a rubber band, right? If the rubber band is your profit, right, you want to stretch it as much as you can get, right? If you can stretch it a little bit, and get more profit, that's perfect. You can stretch it a little bit more and get more profit, that's perfect. You can stretch it a little bit more and get more profit, that's perfect. But eventually what happens is you stretch that rubber band too far, and what happens to the rubber band when you stretch it too far? Right? Boom, it snaps and breaks. And you can see similarities in the results here for the chart in front of you, right? If you look at the pippage, the net profit at the very bottom, right? That's I don't want to say the only number that matters, but that's what's going to matter the most right here for this video's purposes, right? For the baseline test, it was 7,000, right? So anything under that baseline test is not helping, right? We saw that in the last video where the entries actually made it worse, right? So a 1 ATR performed better than the baseline. The baseline was just letting things run until it hit the trail stop, right? So that performed better. 1.5 ATR performed better than 1. Okay, well, let's keep stretching it. 1.75 performed better than 1.5, right? Let's stretch it some more. 2 performed better than 1.75. And you can see, just to pause real quick, you can see that the win percentage does take a hit. That's expected as you shoot for, obviously, as you the more conservative targets you take, typically the higher your win percentage is going to be, right? You get a higher win percentage, you get a lower average trade and less profit. So it's kind of finding that balance. And win percentage doesn't matter all too much, but we did talk about in, I believe, part 1, it matters to the extent of you being comfortable in your skin and actually being able to execute the strategy without self-sabotage for reasons of being scared and whatnot. So it does play a part, and you want to know your threshold. Mine is about 40, just as a reminder. So where we're at, 2 ATR performed better than 1.75, right? We'll keep going. 2.5 performed better than 2. But look what happened when we got to 3. What do you guys see when we got to 3? Win percentage went down a little bit. It was less profitable. So what type of message do you think that sends me about really how much I can stretch that rubber band? Should I keep going to 3.5 and 4? No, we've probably reached that level where we've stretched it so much that it's starting to have an inverse result on your trading. So when I look at those numbers, I can see that 2.5 is most likely the extreme. I guess I could test 2.75 if I want to be really, really picky and see what type of difference that makes. But 2.5 is that extreme of how far I can go with targets before it starts becoming less profitable. Now, I did the same thing with the Q4 baseline test as well. I told you guys I would test this separately just to see what type of difference that make. Again, that was in the part 2 video, and what you will recall was that what that system did was it really it filtered out some of the trades. It did give me a higher win percentage on a baseline level. It also gave me more profit. So it was one of the qualifiers that I wanted to explore and dig deeper into going forward. And just looking at it by itself, you can see that the baseline test was the profit there was 8,892 pips. However, look what happened when I went to 1 ATR instead of the baseline. Is that result better or worse? That's worse. So probably not a good idea to implement that. So, right, 1.5, all right, things got better, but still worse than the baseline. 2.0 is finally where we start actually getting, or 2 times ATR, I should say, is finally when we start getting better than the baseline test. And of course, I kept stretching it out, right? 2.5, okay, even better. 3.0, 3 times I should say, even better. And then once I got to 3.5, look at that, starts getting worse. So again, the threshold for the Q4 qualifier is about 3 times ATR. Now, what's interesting, and this is going to be important going forward, right? If we take both of those tests and we combine them together, not combine them, but we look at them in comparison together, right? During the baseline test, right, the Q4 qualifier outperformed the naked baseline test, right? And that's one of the reasons that it was interesting. However, when you added a different way of taking targets instead of just simply kind of letting everything ride until you were stopped out, well, the original naked baseline test actually performed better than the Q4 qualifier, right? If you look all the way up to really the maximum result, which for the first one is 2.5 ATR, for the Q4 qualifier is 3.0 ATR, it had a better performance. Win rate is still lower, but again, win rate doesn't really matter too much because it's all in my comfort zone. So that is something that is very interesting that I want to pay attention to. And for you guys that are digging deep into the number, it has everything to do with frequency, right? And some of you guys looking at average trade and whatnot, right? Average trade is much better for the qualifiers, which means I'm getting a better type of trade on average, right? It's more of a precision sniper type trade on average. Probably not a sniper type trade, but it's a better trade on average. But again, look at the frequency, right? 109 trades versus 234 trades, right? That is less than or more than half of the opportunities, or I guess the naked baseline trading has more than double the opportunities than the Q4 testing. And this brings me back to a story, right? Story time, guys. Brilliant trader I know, David Alcindor. Awesome dude. Hopefully we'll have him on for one of our webinars in the future. One of the most brilliant minds I've ever spoken to, not even just, obviously trading, but in life. And he had this awesome strategy. Remember, we had a live event, and a live mastermind event. We brought him out there, and he was teaching kind of the inner circle about his strategy. And he worked very, very hard in the strategy. And this strategy, I believe, had about like a 90% hit rate. 90% hit rate. But there was one problem. The frequency just wasn't there. I think when we tested it, we ran it through the tester, it only got about maybe 2-3 opportunities a year. Now, again, I don't know if he's continued to develop it on maybe lower time frames or something, but at that time, it only gave you 2-3 opportunities a year. And the question is, would you rather have a system with a very, very high win rate that only gives you a very small amount of opportunities? Or would you have something with maybe a lower win rate that gives you more frequency and therefore produces more profit? Again, that's the balance that you have to find, right? It's looking at the numbers, it's different. There's no real kind of, I guess, there's no one number that stands out. I guess net profit, obviously your overall expectancy is important, but that frequency needs to be there as well, because you can see in these scenarios that even with a worse win rate, even with a worse average trade, because the frequency is so much higher, it would actually produce more. Now, again, I don't necessarily want to say it doesn't mean you should throw the other one away. There's some cool stuff you can do with that money management wise and position sizing wise, but that's a story for another time. So I thought that was important to show you guys this. There was something else I wanted to mention as well. But I can't recall what it is. So if I remember, I will tell you guys in part 4. Part 4, we're going to be talking about the exit strategy. So the different trailing stop that I'm looking to use. And I don't really know how I'm going to present that or to you guys yet, but I know I'm going to run it through and just see what effect that has on the baseline test and possibly the Q4 test as well. But that should be the last part in kind of the initial preliminary kind of strategy development. After I do that, hopefully I'll have all of the answers that I want as far as coming up with clear, concise rules on how I want to test it. And then I can go to the next phase, the real work, which is actually going through the back testing process, writing the rules down, tracking it trade by trade over all of these pairs, seeing what the results are, creating a portfolio, and trading it live. So that will be pretty cool. Of course, before you guys leave, do me a favor, hit that like button. If you guys are brand new, thank you for finding the channel. Subscribe, hit that notification bell. That way you're alerted each and every time I upload a video. And feel free to leave a question or a comment below. I got a really good comment the other day. Let me see if I can find it. And I really take pride in these type of comments because you guys that have been with me for a while, you know that one of my main jobs, or not main jobs, but one of my main goals is to really scare away the, I don't want traders watching this channel. I'm very particular about my tribe. Let's put it that way. I'm very particular about my tribe, meaning that I just don't want followers. That's why I don't pay for followers on social media or anything like that. I want to work with serious traders, and hopefully the way that I present and how I talk about trading, it typically it pisses people off. It scares them away because I'm not telling them you can get rich quick. I'm saying it takes a lot of hard work and you're probably going to fail. But it filters out those type of people and really focuses on people that are serious about their craft. And I got a cool message by Shaquille. Awesome name, by the way, because it rhymes with Akil, and I'm super awesome. But it says, this is one of those non-glamour videos that many will sleep on, right? Sleeping on means like many won't pay attention to. They'll skip past it right away because they're not seeing charts. But Akil, my dude, I truly understand and appreciate the value that is being given here. Absolute confirmation that I'm on the right track. Blessings and continued prosperity in 2020 to you, brother. And I love that because this is what it is, man. These aren't glamorous videos. These are dirty, grimy, gritty, boring videos. But anyone that has been consistently profitable in trading will tell you trading is the same way. Trading isn't glamorous. It's not bells and whistles and loud noises and you know, drugs and parties. Maybe it's drugs and parties to some of you guys, but not us. It's kind of a boring do your job type of deal, right? You come in, you have your plan, you follow your plan, you execute your trades, you track your trades, you close down your charts, you repeat the next day, and it's really boring and monotonous. But when you get to that point, you know that A, you're running your trading like a business, and B, that you are no longer emotionally involved in the market, meaning you're no longer basing decisions off of how you feel and chasing those highs, right? You're basing it off of, you know, what your business plan says to do. And once you've reached that level, that unconscious incompetence level where you're just running on autopilot, or not unconscious incompetence, sorry, unconscious competence level, then you know you've made it. So I appreciate the comment. Feel free to keep leaving them. It makes me feel good about what I'm doing. And I will see you guys in part 4. Until then, plan your trade your plan. Take care. You guys have a great weekend.